A very warm welcome to our second public lecture, part of the Dean's Distinguished Speaker Series. I am Rachel Lam, a second-year business student here at Nanyang Business School, and I'm very excited to be your MC tonight. It's great to see all of you here at Gaia Auditorium, not forgetting those of you who are joining us online from all over the world. Thank you for being here with us tonight. Tonight, we will explore the role of private capital in driving economic growth with a focus on the buyout market. Also, we will discuss why buyouts have gained such momentum, how firms create value through them, and their transformative impact on businesses. We're also very excited to share our next event, Thriving with AI, Agency and Understanding to Make AI Work for Society. Do scan this QR code up on the screen and sign up if you're interested. If you have any questions during today's session, feel free to scan this QR code and type in your questions. Thank you also to those of you who have sent in your questions beforehand. The speaker and moderator will address them to the best of their abilities. Now, it is my privilege to introduce the Dean of Nanyang Business School, Professor Jun Yang, for her opening remarks. Dean Yang, please.
Thank you. Welcome, everyone. And if you're here with me at Gaia Auditorium, I hope that you enjoy the music, you enjoy the food, and you enjoy the company of each other. You probably have learned this building, Gaia, just won the very precious award 2 days ago from UNESCO. So this is the most beautiful campus, right, for this design of the building. In the world, by the way. For those who are dialing in online, a warm welcome to you all. Thank you. So today we have actually 700 people sign up, either online or in person. So I'm very delighted to start this second public lecture of the Dean's Distinguished Speaker Series. And this is a platform, I can say this is a flagship platform where we bring the global thought leaders and let them communicate directly with academia as well as practitioners and policy makers. So the first talk was about financial decoupling between US and China. Today we have the privilege to invite Professor Michael Weisbach. Mike has been a friend and great mentor for me and many people, many of my colleagues in the audience for many years. Mike is an expert in corporate finance, corporate governance, and private equity. So if you're interested in corporate boards, he is probably the 3 top leaders in the world in academia to share his insights with you as well. I'm very sure Mike would give us the insights that would promise very, hopefully, thought-provoking discussions after the public lecture. So to guide today's conversation, we're honored to have Mr. Keoy Soo Earn as our moderator. Mr. Keoy leads Deloitte's global consulting for private enterprises and their Southeast Asia practice. Keoy spent, I just heard, 3 years on the NTU campus and graduated in 1991. So if you know about NTU history, he spent 3 years here. That's how many years we have for the undergraduate program. But he got the NUS degree, right? So that's when we start to move everybody from NUS to NTU. And this is essentially how closely the Singaporean universities are working with each other. So got an NUS degree for NTU education, which is a very good deal. So Keoy has decades of experience in strategic transactions, and he has been recognized as one of the world's top IP strategists in intellectual asset management. And he is a leading due diligence accountant. So we started with the best accounting school in Singapore by Who's Legal. A platform that highlights exceptional professionals worldwide. So beyond his professional accolade, Mr. Keoy is a champion of sustainable development, and he serves on various boards and councils to tackle pricing legal challenges. By the way, we're launching another public lecture series on January 9th. So that's a sustainable business public lecture series. Stay in tune. We're going to have more information on that. Mr. Keoy has a great ability. He's a great ability to navigate complex issues with clarity, makes him the perfect moderator for tonight's discussion. Mr. Keoy, thank you very much for joining us. Ladies and gentlemen, please join me in welcoming Mr. Keoy Soo Earn. Thank you.
So I should say good morning, good afternoon, good evening, because there are many people who are online. So our dear Dean, you have made my life very tough. Thanks for all the kind words. But the key person for the show is not me, it's Prof. Michael. I think that's something that you all need to be aware of. Don't direct questions to me because I'm not in the position to answer. To help all of you remember my name, because it's not easy, I graduated from accountancy, 91, that's correct, and I'm very glad to be invited back. But my father always has a vision that I should be a lawyer. So when I was born, my parents gave me the name Soo Earn. So you sue, then you earn. But unfortunately, it's not spelled as S-U-E. So it's spelled as S-O-O. So when you send me an email, please don't write S-U-E. So there's no Miss Sue. So that, please remember that. But for me, I'm going to be the moderator, but what's important is that I'm the gatekeeper. But Prof. Michael has already tells me that any questions that is being posed to him that he cannot answer, he's going to redirect to me. And I can redirect to any of the audience. Because some of you are definitely smarter than any one of us. Because certain topics you may have actual experience that you are able to share with the rest of us. But when I look at Prof. Michael's credentials, what catches my eye is not all the different universities. It's the things that he has 67 publications on related topics. And being a professor always very open. Whatever they do, whatever they research on, they always publish. Then his articles, his different papers has been published, those has been downloaded more than 100 times. 100,000 times, not 100 times. Sorry, because when I play with numbers, I always forget the last 30. So it's more than 100,000 times. And his publications, his white papers, has also been cited multiple times, more than 50,000 times. So if you can see how much he is being looked up to, because when people cite what you've written about, it's always carry a lot more weight. But what I was told, since we are talking about next speaker series, not this one, thriving with AI. One key thing I need to tell Prof is that we publish everything, then we download everything, we put the AI on it, then we're going to have another Professor Michael, number 2. So if those questions that we are not able to help you answer today, you can do what I just suggested to you. Take all his publication, take all his book, download them, and then you try and ask the question. You may have a co-pilot answer, but make sure you pay for the co-pilot. But without further ado, let me welcome Prof. Prof. Michael, over to you.
Well, with that, that kind of introduction, oh my God, I don't know what I'm going to say. It's a great honor to be here. It's great to be here. I just want to say that, you know, I'm a professor at Ohio State University, and I know our department actually has a very strong relationship with this department, because our most productive alum, we have produced lots of doctoral students, but the very most productive one is on the faculty right here. He can't be with us today, but he's Jungkook Kang. And then, I joined in 2008. And as soon as I joined, they said, "Oh, but you missed the two best students we've ever had." And they're both from Singapore, and they both had to go back they both went back to Singapore, and they're both sitting in this room here. So Roger and Angie are two of our distinguished alums, and Angie's now the department chair. And so anyway. That's it. So it's a great honor to be here, and I can't believe there's 700 people signed up. So I will I was at a conference like 3 or 4 weeks ago in North Carolina in the U.S., and I met somebody from Stockholm, Sweden. So Stockholm, Sweden isn't actually close to here, but she said, "Oh yes, I hear you're giving a talk in Singapore." I was like, "How do you know I'm giving a talk in Singapore?" And apparently there is something called the Finance Professors Hot Pot Club, which is a WeChat group, and so there's lots of people from the Hot Pot Club. So I expect hot pots next time I get to meet any of you. So this will be very good. So anyway, so this is my talk is on buyouts, and so it's really kind of a big picture talk. So I can't answer any questions on what's going to happen in the Asian buyout market and which sector. I can't do anything like that, because you guys know much more about that than I do. But I'm trying to sort of be the professor and kind of give you a perspective on, what buyouts are, how they work, and what kind of, how to think about them when you talk about it. Because, when you hear the discussion in the press about private equity and how it works, it's always completely confused, and it really doesn't understand the value that private equity and buyouts in particular create for society. And so let me start by a few facts, okay? So that what this is the private capital market. And the private capital market is just growing like mad. So these are trillions of dollars, so trillions of US dollars. So this is the assets under management, and each of the different colors represents a different part of the private capital market. So the red one at the bottom is, you can see there's a little pointer there, is the buyout market, but there's also venture capital, real estate, growth equity, infrastructure, direct lending. I talked about direct lending in this morning to the academics, and secondaries, which is a whole separate branch of research that I do. And you can see it's went from 3.5 trillion to 12.8 trillion in a 10-year period. So that's pretty fast growth. And so the question, so if we think about, there's a bunch of ways to do the math. You can think, the previous graph was about the total assets under management. Another way to think about it is the capital raised. And so just in the US alone, private capital raises about $1 trillion a year. About half of it is in buyouts. So this is a lot of money by any way you count it. And so the question, I think, is sort of why is money being allocated this way, and why are buyouts such an important financing vehicle? And what does the future hold for the buyout market? So I mean, I think these are questions that, hopefully everyone is kind of a little bit interested in, otherwise you wouldn't have come to the talk. So what I'm going to do today is I'm going to start off by presenting some basic facts about the buyout market. I'll talk about the economics of it and how buyouts work. I'll talk about why buyouts have become such an important phenomenon. I'll talk about different strategies that are used in the buyout market, because they have a whole wide variety of strategies they use. And then I will give some speculation on my own on the future of the buyouts, and more generally about private capital markets and public capital markets, and what the difference is, and why private capital markets have been growing so rapidly relative to public capital markets. And so there's lots of students here, so I always say to the students that, as part of your education, so that you should think about what the world will be like when you're my age, and I think part of the way the world will be is that private capital markets will be even more important than they are today. So I think if you're a business student, it's incumbent of you to learn a little bit about how they work, because most of the way universities work is they're always backward looking, because we always teach the same courses that we had when we were students, and they tend not to be forward looking and thinking about what life will be like when you guys are earning a living. So I think that's the way you should really approach your education. Anyway, so let me start with some facts. So unfortunately, these graphs are not in color, but you can see this is the number of funds that are raised, and it's broken down by location. So the bottom is North America, then Europe, and then that's the second biggest, and then the one right there is Asia Pacific. And one thing that for you here, you should notice that Asia Pacific in 1995 was like nothing, and then now it's a really big part of the private capital market. And again, it's just growing faster and faster. And as we heard from Soo Earn, that it's becoming a big part of Deloitte and other firms' businesses. Now, what this is the buyout. So this is what the previous one was the number of funds that are actually raised. Now, the second way to look at it is how the funds do their spending. And it turns out that they raise money at a much more sort of continuous way than they spend it. And the spending is very much dependent on the economy. So you see that there was like a big blip before the financial crisis in 2008 and 2009. Then it dropped off, and then it kind of grew rapidly. And then in the last couple of years, it's been even more. Although this stops in 2022, I think 23 and 24 were a bit slower than that. One of the challenges about giving these talks is you kind of have to keep updating the graphs, and they're like 2 years out of date. Okay, this is the assets under management. So in other words, the way you think about it is the private equity raises things through funds. And so you raise a fund, and then you spend it over a 10-year period. And so the assets, the one graph was about the amount of capital that was raised in funds. Another was about the way it was spent in buyouts. And this is about the total assets that are under management, including the capital that's been committed but not yet spent, which is called dry powder. And that dry powder is right here. So the dry powder is, again, this is a term in the industry that refers to the amount of capital that has been raised but not yet spent. Okay, and so basically the way buyouts and anything in the private capital market works. So private debt works very similarly. Venture capital works very similarly. Real estate funds work very similarly. Is that they're done through these things called funds. And so one of my theories is that funds are becoming an important way to do financing, and I think there's some number of advantages that if any of you PhD students are looking for topics, I think understanding the way funds work and why funds are such effective financing vehicles is important. Now, the way funds are they're long-term commitments of capital, usually but not always 10 years. And these are done for the investors. And the investors, funds are usually limited partnerships. So if you always hear them, the people in the business talk about LPs and GPs. The LPs are the people who provide the money. So they're usually large institutional investors. The GPs are the partners who make all the decisions about how to spend it. So basically the LPs make a long-term commitment to the fund, and then the GP decides when to make the investments and how to manage the investments and then how to exit the investments. And so the LPs basically sign over their money for the GPs without much recourse. And sometimes it's possible, but usually expensive to exit the positions. There's a secondary market for these funds, but it's a very immature market. It's also growing rapidly, but still, you don't want to invest in one of these funds unless you're planning on holding it for a long time. And usually they delegate all decision rights to the fund managers. And the thing about these funds is that the fees are very high. So you hear the term 2 and 20. What that means is that the 2 is a management fee, which is a percentage of the value in the fund. So when you saw that picture of assets in management, if those funds had a 2 and 20 fee structure, then 2% of every dollar that was under management would be given to the managers of the funds, both for their expenses and also for their compensation. And then, in addition to that, they have what's called 20% carried interest. And what that is a share of the profits. And so, as a result, the managers of the fund get to keep usually 20% of the profits of the fund. Now, these numbers aren't exactly accurate for every fund because, as Soo Earn will tell you, the LPs are always trying to drive down the fees, and the GPs are always fighting over this. And so, but 2 and 20 is kind of the traditional amount. But the 20 is the profit share that the manager gets to keep. And so if you're talking about, some of these funds are 10, 20 billion US dollars, the 20, if they earn a decent profit, then 20% of that profit adds up quite substantially. And so some of the partners in the biggest funds are some of the wealthier people in the world, really. Okay, so that the thing about it is that the LPs provide the money to the GPs, and so what they have to do is the GPs have to give the LPs kind of a pretty large return to make it worthwhile, because the LPs basically have to tie up their money for a long period of time with no discretion over how it's spent. The funds, the money is actually fairly risky, so academics will argue over exactly how risky. I have a paper where I argue the beta of the fund is typically about 1.7, so it's much more risky than a typical equity. And the reason why is because the buyouts are actually, you may have heard them as leveraged buyouts, because they're almost always leveraged. And what I hope all you students know from your finance classes is that when you add leverage to an equity, you increase the risk and the return and so the leveraged buyouts funds are very leveraged, and so therefore they have higher risks and higher returns, and the returns are why the GPs like it, but the LPs have to be aware of the risks that they face. And finally, the fees are pretty substantial, and so that basically what the GPs have to do, it's a pretty hard game, they have to earn enough on their investments so as to pay themselves these fees and still have the net of fee returns be large enough to offset the risk and illiquidity of the funds. And if you ever talk to a GP, they'll say, yeah, their job is pretty hard because, especially in like a space like venture capital where half of the deals go to zero. And so, and they still have to offset the risk and illiquidity. In a buyout, similarly, they don't go to zero typically, but they have to earn substantial returns. And the interesting thing to me about this market is, despite the fact that they have to do so much with the money to increase the value so that they can pay themselves the fees and still offer their investors a return that's high enough to offset the risk and illiquidity, you saw the numbers, right? Despite all of that, the amount of capital in this business is growing like leaps like you couldn't believe, right? It went from 3 trillion to 12 trillion, a factor of 4 in 10 years, right? So obviously the people providing the money, the LPs, think this is a really good place to put their money, and despite the high fees, the risk and illiquidity, it's still worth it to put their money there, okay? And so the question is why? Well, returns have historically actually been good. These numbers are pretty old, but the average TVP, that's the multiple of cash that's returned relative to the amount of cash that's gone in, is about 1.6 for US buyout funds, 1.5 for Europeans, and 1.4 for Asians. Don't take these numbers too seriously. They're from older data. But the average PME, which is basically how much they earn relative to the U.S. public equity market, is bigger than 1, which basically means they outperform the public equity markets, because if they didn't outperform the public equity markets, why in the world would you bother investing in the private capital market in the first place? And so the question is, how do GPs do it? And to me, this is sort of the fundamental question in understanding private capital markets. And if you think about why private capital markets are growing so rapidly is they must have some way of waving their magic wand and making the values of these companies go up, okay? And so often you read that, well, investors just throwing money into this sector because interest rates are low and they've got nowhere else to put it. I don't kind of buy that. I think that the reason why investors are putting money in the sector, for the most part, is because the returns are good. And why are the returns good? Is because of basic principles of corporate finance. So that basically, what the one thing that I'd like you to come out of this little talk thinking is that the buyout funds, or private capital in general, they simply make investments that could not be made by other traditional financing vehicles. And so therefore, as the world gets more complicated, the set of investments that could be, financed by a bank or a public equity issue is just getting smaller, and the set of investments that require this kind of fund structure is growing. And that's my view, is that is why the private capital market is growing so much. And so let me go back to what you all learned in Finance 101, or whatever number you use for that in this university. But so that June, before she was your dean, she used to teach corporate finance at a university, not at my university, but at a university very similar to my university, okay? And I never took her course because I was never a student there, but I can tell you that what she probably told the students was that the way, corporate finance works is that management would go and propose a project, okay? And then they would do a bunch of calculations that is a central, and how to do those calculations is kind of the central focus of the first course in finance, and to calculate this thing called the NPV, and I'm not going to tell you what that is if you don't know already. And if the NPV, and what June would tell you is that if the NPV is positive, then you go ahead with the project, okay? And if it's not positive, you don't go ahead with the project. And sometimes, managers go ahead anyway with the project, and we call those agency costs, but that's a whole separate lecture. So, but typically what would happen is that the firm would finance this with debt if it's relatively safe, and would finance with equity if it's riskier. And basically, the thing about it, it's a very straightforward exercise. It all depends, of course, on interest rates and cash flow forecasts and things like that. But you're essentially relying on the management team. The management team proposes the project and executes the project, and so that you as a financier would then choose to give, the bank would choose to give the firm the money or not, based on what the management says, okay? Now, when I was preparing this lecture, okay, I came up with a term. So don't look up this term in any books, because I'll be really annoyed if you do find it, because I thought I invented it. But it's something called a conditional project. So in other words, what I described on the previous slide might be called an unconditional project, where basically you give the manager the money and he or she does what he wants with it, and then hopefully it turns out to be a good investment for the shareholders. A conditional project is a project which is positive NPV, but only if certain conditions are met. So in other words, it might be that an acquisition would be a positive NPV, but only if there's a management change, or if there's a divestiture of the division. So in other words, it could be profitable to buy another company, but only if you were willing to sell off the one division that kind of didn't fit with the rest of the company and create value that way. Or if, you might have a company that has great assets and a terrible operating strategy. And so you would have to take over the company to change the operating strategy. But if you simply gave the money to the current management team, they wouldn't change the operating strategy, and it would be a negative NPV investment. And so what I would argue is that what private capital is able to do, it is able to make these conditional projects that are not able to be made by public capital markets. And so that what I think, and again, so the reason why I think the growth of the private capital market has been so substantial is because investors have realized that there are many of these conditional projects out there, and that they think they can be earning returns by funding these conditional projects, and that's the way the private capital market is able to do that the public capital market simply cannot do. And so that at the end of the day, the reason why the growth of the private capital market is so great is because of the importance of these conditional projects. So, anyway, I've been talking fast, and so let me just, okay, so I have half an hour more? Yeah, I think so, yeah, good. Okay, so, all right, so what is a conditional project? Okay, a conditional project is, well, suppose the company is worth $30 a share with the current management and policies. Now, maybe it could be worth $50 a share if there is a management change, a divestiture of the manager's favorite division that maybe doesn't earn money and doesn't fit well with the rest of the assets of the company, but the manager likes it, so he keeps it. An increase in debt that forces the manager to stop wasting the firm's free cash flow. And so that basically, in this situation, acquiring the company for maybe $35 would be a positive NPV, but only if you could enact these changes, right? And so this is so basically this is a case where the capital that is being sent to the private capital market could increase value, but only through this sort of fund structure that allows the manager, the general partner, to take control of the company. I didn't really get into the details of the way that they make their investments, but even in a venture capital situation, private capital financiers almost always get a lot of control rights and are able to influence the management of the company in a way that public capital investments can't, right? And I'm sort of thinking about banks, even though they're private, as being sort of a traditional public way of financing, sort of that's different, that's distinct from investing through funds. Okay. Okay. So buyouts and conditional projects. Well, buyouts are usually, what they usually do is they give control to highly motivated, knowledgeable GPs. Okay. And one of the things actually we talked about in the seminar this morning, was that the general partners are generally very talented, skillful individuals, and they are able to increase the value of their portfolio firms in a big way. So that I think that the amount of skill involved in managing a buyout fund or a venture capital fund is substantially more than, maybe this is controversial, that a mutual fund. So that, I don't know if you do this here at Nanyang, but at most of the U.S. business schools, we're perfectly happy to let our MBA students manage a section of our public portfolio, because how wrong can they do by picking Google versus Apple? And so long as they pick those, they just keep going up and up. But for private capital, we would want a professional to really manage the money, and there are definitely differences in skill. And one of the stylized facts that I'm not going to show a lot of numbers here, but that there is a lot of persistence in the performance of private capital markets, because the best people generally earn the highest returns, and they keep earning the highest returns. So Sequoia Capital in the VC world and Blackstone in the buyout world, they have done tremendously well for 25 years, and they're still doing tremendously well in all their funds, because those people are just basically brilliant, and they're very, very good investors. So that basically, what the thesis of the talk is that buyouts can create value by taking conditional projects that are not available through traditional finance. And so what can GPs do that small shareholders, banks, and bondholders can't do? Well, they can manage the firms actively. They can change management teams. They can change strategies. They can be flexible in their investments. They can acquire different kinds of securities, right? So that if you are a buyout fund, there's nothing prohibiting you from, making an investment in a small cap firm if it's really that valuable. If you are a debt fund, you can buy equities if you want, right? I mean, now it's not often advisable to do that, but they have a certain flexibility. If you have debt and the firm goes through Chapter 11, you can take over the company and swap your debt for equity and create value that way. And so that they can be flexible. The other thing that is incredibly true is the incentives in these firms are very, very strong. So they get 2% management fee. They get 20% carried interest. But their incentives are even more than that because there's a strong relationship between the success of one fund and then your ability to raise future funds. And so therefore, if you do well, if any of your students go and you're able to raise capital and you are able to get a really good return, basically you're set for life because you can then raise a second fund and then a third fund and you earn 2 and 20 on all of those subsequent funds too. So that your incentives to do well in your first fund are just enormous. I have another paper where I actually calculate that and it's very, very large. And so therefore, they have very strong incentives to maximize the returns of these funds, which means managing the companies efficiently and creating value through their shareholders. And what they've done is the GPs have come up with a number of different strategies for taking projects, which are basically all what I would call conditional investing. And what I'm going to do now is sort of go through a bunch of those possible strategies. And there are many more, but I think I have 9 listed. And you could argue about whether these are buyouts or some of them are different kinds of investing. But basically, the thing about it is they all require kind of active management on the part of the buyout fund that could not be done through existing management. So the first strategy, which was one of the most famous finance professors who ever was a guy named Mike Jensen, who passed away recently. And he talked about the need to, what he called the free cash flow problem in corporations, i.e. that when you have a corporation that generates a lot of cash flow, well, basically, the American expression is it burns a hole in your pocket. That's what Americans like to say. So basically, it means if you have a lot of money in your pocket, you like to go and spend it on, some people go to the bar, some people go this. But if a company has lots of money in their pocket, and they don't have any responsibility, they will go and they will buy 12 private jets, and they will buy sports teams or buy whatever And so, what Mike Jensen would argue is that these are often not very good investments from the shareholder's perspective. And so what he would say is that by acquiring, by changing the capital structure of the firm through a leveraged buyout, you then make the manager worried about paying off the debt, interest payments on the debt, and so they don't have any money left over to buy all the private jets that they don't really need. And that was kind of one of his famous arguments. And so this is certainly true as a way that to the extent that the buyouts change the capital structure, almost always increasing leverage dramatically. This is a way that the buyouts can create value simply by reducing wasteful expenditures in firms. Okay? A second strategy is refocusing all the operations. I mean, a sort of a general theme, I think, of courses throughout the business school, is that companies tend to, have a little bit of hubris, and they tend to buy assets in areas they really kind of don't know about. And so they will buy, you'll have these conglomerates that invest in 12 different businesses in completely different areas, and that don't fit, they don't create synergies. And so what a buyout will often do is it will refocus assets, and it will restructure the company and sell the assets that are not particularly valuable. Okay, And so that what buyout funds would do is they will look at the value of each asset individually. And, again, because of the fact that their pecuniary incentives are just so large, if an asset is not adding value to the company, they will sell, and they can get more from a potential buyer than it's worth to the company, they will sell it. In other words, this all comes from the fact that the general partners, they don't have any emotional attachment to the company. They have strong incentives to maximize the value of the company, and as a result, if they think an asset should be sold, they will sell it. And you see a lot of divestitures of unprofitable operations around buyouts. Strategy 3, enhancing executive management. They replace the chair, CEO, and senior executives. There's often management changes around buyouts. I actually, one of the things I do when I teach my course, I teach a course in private equity at OSU, and I co-teach it with a former practitioner, and he always tells the story of how he bought an electric utility in England, and he went and met with the board, and the first thing the management said to him was, well, we want to expand operations in Turkey. Well, I mean, if you have even looked at a map of Europe recently, but England is nowhere near Turkey, and the guy had no financial policy, and so basically he called a break in the meeting, and he told the CEO to not come back for the second half of the meeting, and he reran the company. And this was an extreme example, but they often will get rid of managers that kind of don't know what they're doing. And I think the C-suite is a really important, obviously, part of running a business. And just empirically, you observe a number of management changes, around the time of leveraged buyouts. And again, it's all done with the shareholders in mind, because the buyout profession, the general partners are themselves shareholders and have a big stake in the profits of the company. Operational efficiencies, there's a number of them. They improve IT systems, they outsource, they do all kinds of what's called operational engineering, which is, so I think one of the changes in the buyout industry is they used to simply buy companies, add a bunch of debt, and sell a bunch of divisions. But lately, what they have done at most firms is they have what are called operating partners, and they specialize in improving the operations of companies, and they're really professionals, and so that you would have, one of my research papers is about airports, and so there are some companies that specialize in improving the operations of airports, and so they buy airports around the world, and so they really know how to improve airports. And as all of you probably travel more than you want, like I do, and you have some airports like the one in Singapore, which are wonderful, and you have some airports like the ones in the U.S., which are not so wonderful. And one of the things that's happened is that private capital has bought a number of these airports and has improved the operations. So, okay. Scale economies are really important, and that can come in various flavors. So that one of the classic strategies is called a roll-up. So in a roll-up, if you haven't heard that term, basically, well, if you go to a random dentist office in the United States, or a random, the place where I bought these glasses, they are often run by private equity firms, because basically they used to be like every dentist would manage his own office, and he would do it badly, and he doesn't know. If you're a dentist, you probably don't know much about billing and receivables and all the stuff that you guys learn about in class. And so what happens is the private equity has able to, by buying 10 dentist offices in a city like Columbus, Ohio, they're able to, manage, purchase the equipment more efficiently and manage a million things more efficiently, and let the dentist worry about teeth and not worry about running an office. And so it turns out to be a much more efficient way to run these kinds of offices. And these roll-ups have been a traditional source of value for private equity. Another way, and basically it's a way of adding scale to a small business that doesn't necessarily have scale. So if you were setting up your own dentist office, you don't have scale. You have, But by taking 10 of them together, you're able to do everything professionally and efficiently and create value that way. Another scale economy is by what are called add-on acquisitions, so that the general partner will buy a firm, and then one of the things they might do is they might promise the owner of the firm that they would provide capital for expanding the scale of the firm, and so providing capital for an add-on acquisition that the management might not be able to do by themselves. Okay, and so and it could also be managed by taking businesses to other countries and internationalizing the business, and so there's lots of ways that they take care of scale economies. Number 6 is what are called corporate orphans. A corporate orphan is basically a division that the corporate parent doesn't kind of like very much anymore. So basically, I didn't invent the term, but basically what it means is that if you have a division that sort of doesn't fit very well, and lots of the resources of the company are not being devoted to that division, then they can be improved by the value of that company can be improved if it's acquired by a private equity firm who run it as a standalone division. So I don't know if any of you guys wear clothes from a company called Express. I think they're actually in different countries now. That's a Columbus, Ohio company, and it was owned by the Limited, and the Limited didn't given it enough TLC. They did a leveraged buyout, Golden Gate Capital in 2007, and despite the financial crisis, they had a 5x return in 3 years, and then did an IPO. And because they were able to operate much more efficiently without kind of the overhead of the parent that sort of didn't give them the best locations and the best advertising dollars. So that was an example of that. So. Okay, privatization. Okay, another thing that happens is a lot of assets around the world have been privatized. A lot of the attention has been focused on the post-communist countries, but even within capitalist countries, as I mentioned airports a few minutes ago, they have been transitioning from government control to private control, and private equity has played a big role in that. So that, again, that private equity owns a lot of infrastructure assets, not just airports, but seaports and toll roads in the US and all kinds of things like that. And private equity is able to add value to those companies simply because they're much more efficient than the government, and so somehow the private capital market has worked much better than the public capital market in adding value there. Okay, another is transition in ownership, and I'm just sort of. This is all, by the way, this is all taken from a survey paper that I wrote with my friend Tim Jenkinson, who teaches at Oxford, and a former student named Haek Kim, who is supposedly on Zoom right now, and she is a professor at University of California at Riverside. And so what we did was we sort of listed all the different strategies for, why buyouts could create value. And the tradition of ownership is often you have family companies, right? So I don't know if any of your families own a business, but you may or may not want to run that business, right? There's lots of family businesses where the son or daughter wants to be an artist and they don't really want the family business. And so the question, or you have a situation where you have 3 siblings and one of them wants to run the business and 2 of the others want cash. And so what happens in this situation? Well, private equity has developed a model for allowing the people who want to stay in the business to stay in the business and to provide liquidity for the people who want to exit the business. And so there's a bunch of firms that specialize in this kind of thing. And so basically, this is just another example of what I call conditional investing. So in other words, these are investments that are valuable, but only if you know how to manage a family business and how to facilitate an orderly transition within a family, right? So this is a very specific kind of firm, but what happens is that people raise capital for doing very specific kinds of deals, and they become specialized in it, and they're able to make conditional investments to solve these particular business problems. Finally, the last strategy I have is distressed investments, and Basically these are buying companies that are entering financial distress, and there are firms that specialize in managing the distress. Often what they will do is they will do a restructuring of the firm's capital structure, replace some of the debt with equity, and allow some of the debt holders to emerge as equity holders and do well. So those are strategies, and I think if there was if Soo Earn were to come up, he would probably list 9 other strategies that are done by private equity firms. But the common, what academics are sometimes good at is identifying sort of common themes that run through examples. And I think the common theme here is that these are all investments that would not be possible under traditional financing vehicles, but create a lot of value through the private capital market that is done through funds. And so that basically traditional finance works well for projects that existing management can propose and operate. Again, this is the Finance 101 example I gave a few minutes ago. The 9 strategies and many others could be all conditional, and so these are kinds of these are strategies that could be done through buyouts, but not through traditional finance. And this is one of the reasons why the capital being allocated to buyouts and other private capital has been growing. Okay, and so what does the future hold? I have 7 minutes, so I will talk about one of my rules is I never, ever run over when I teach a class. So I will end right at 8:30, and you have a nice clock up there. So what does the future hold for buyouts and private capital more general? Well, if you think about the reason why capital is flowing into the sector as the corporate finance of providing more value, as opposed to some scheme on somebody's behalf to manipulate the capital market, or to interest rates are too low, so they have to find some. I think that happens, but I think the vast majority of the investment in this industry has to do with the simple fact that the money is able to be used effectively through the private capital market, and that the private capital market has developed a way of kind of sending the value that is created through those assets to the investors in the fund. And so the future of the private capital market will, at the end of the day, depend on the value of conditional investments versus unconditional investments. And so you may say, well, how do we know what are conditional investments and what are unconditional investments? And to me, I don't know, we were talking about beforehand about sort of the state of the world and all the crazy things going on in the world. And I think the one thing that everyone will agree is the world gets more complicated every year and not more simple. And I think investing is kind of the same thing, where investments in firms, that it's not the case that the management will propose a great project and the bank will simply finance it. I think most projects will over time will involve more active management on the part of the investors. And this is true, I think, I thought about changing the whole talk to talk about private capital more generally. But, I had 9 strategies for buyouts. But, if there was a venture capitalist here, he would have any number of strategies by which venture capitalists come up with new firms. Real estate investors are the same thing. There's a fund in Columbus, Ohio that I know well. I'm from Columbus, Ohio, so I know our local firms well. But, what they do is they buy up hotels that often they are in great locations, but they're kind of shabby and they're not so nice inside. And so what they do is they fix up the hotels and make it nice and then sell it to somebody else. And they've had great returns because basically there's a lot of hotels in cities, in the U.S., but probably the whole world, that have great locations, but kind of are not so nice. And so therefore, these guys know how to take an old hotel and make it much nicer. And this is a kind of investment that requires a professional who's really good at fixing up hotels, right? So that, again, the market is set up so that there are lots of investors with very specialized skills at improving companies that really are able to add value. But in order for this to happen, the financing of these investments has to be through funds in the private capital market and not through the public capital market. And so that as the world becomes more complicated, more and more investments will be conditional, and new technologies will be increasing at an increasing rate, which again will lead to venture-backed companies. And one of the other things I wanted to mention is that there are new kinds of funds in the private capital market that appear all the time. And so I teach a class on it, and I still am shocked at all the new funds I hear about. There are these things called secondary funds. You guys don't know what those are. Those are funds that invest in stakes of LPs that want to sell their stakes. And so there are billions and billions and billions of dollars being raised in these secondary funds, and basically these are basically taking advantage of LPs that change their mind to decide they don't want to hold the asset for 15 years. And so the people who buy the secondary funds are able to purchase them relatively cheaply, and the returns have been terrific on these secondary funds. And so now there's a ton of money flowing into secondary funds. So who knows what's going to happen in the future, but that's what's happened there. Continuation funds, again, I was talking with Soo Earn a little bit about these beforehand. And the continuation fund, these are funds that are set up by a GP where they have a favorite asset that they want to hold longer and they don't want to exit in 10 years. And so what they will do is they will literally raise a whole separate fund to acquire the asset from their old fund. And they give all the LPs in their old fund the option of what is called rolling into the new fund and acquiring the assets. And for some reason, I don't understand, most LPs don't do it because the returns on these continuation funds have been really good because these are the assets that the GP really loves and wants to hold forever. There's a fund I just found out about called GP Stakes Funds. And what a GP Stakes Fund is that it goes and acquires, the GP owns equity in their own funds, and so what it does is it creates a new fund to acquire the equity in the stakes of the old funds. Okay? There are funds that provide capital for lawsuits, and you name it, there's a new kinds of funds. So one of the things we do, you're laughing because you know about all these things, yeah. So, one of the things we do in our class is we make the students come up with their own funds, and one of the things you guys should realize, those students out there, is that you have a big advantage over us old people, and that you are far more creative and innovative than we are. And so the students in my class always come up with the very cool ideas for funds, and then sometimes we see that 3 years after the class is over, we'll hear about some guy in the market raising the fund that the students proposed in my class, which we always think is very nice. So, but anyway, so my friend Tim Jenkinson has a saying that I really love. He says that private capital markets are at least as important and far more interesting than public capital markets in the 21st century. And I really believe that's true. He also says that the driver of the growth in the world economy in the 20th century was the public capital market. The driver of the world economy in the 21st century will be the private capital market. And I would encourage all of you to sort of learn more about it. And those of you who are planning your careers, think about it because it's really important and interesting. So that being said, I will turn it over. I guess we're supposed to do Q&A now. So Soo Earn, you got to come back. Yeah. So.
Thank you, Prof. Michael, for your insightful lecture. May I invite you to take a seat on stage? We will now move on to the discussion and Q&A segment moderated by Mr. Soo Earn. Okay, Mr. Soo Earn, over to you.
So Prof, thanks for the enlightenment. When I was studying, I know a lot about fund because it's without the D. But when a professor gives me a rating with a D, then I'm very stressed. So you can imagine when you're running a fund, trying to generate a return in order to pay 2 by 20, that's not going to be easy.
So June, I have some advice for you. I think you should hire him to teach a class. The problem is that he'll make all the other professors that you have look really bad because they won't be nearly as good.
Do we want to hire?
My only problem is that if all of you start listening to me, I don't think you can pass the exam. So Prof, see there's so many questions, so I think you guys are very active. But later we'll open up for Q&A from the audience, but let me address some of these questions that has been posted here. So Prof, just thanks for sharing all the nice strategies. And then based on what you have seen in the world, as well as all your interactions with all your great friends around, which one of the 9 strategies will work best in the 21st century?
In the 21st century. I think the scale economies are really important. I think that the roll-ups and the efficiencies and professionalization of small businesses is something that's going to continue. It's been the case in the U.S. My guess is around the world, it's going to be even more important. I think.
So Prof.
But that's just my. I don't have, and that's based on no data whatsoever. So just.
Sometimes intuitions is much better than doing too many analysis. and sometimes you always say that thanks to NTU, although you can blame it on NUS, I have an NUS degree, when we analyze and we overanalyze, we paralyze ourselves because after that we don't know how to make decisions. That's why I don't have a shares. I didn't buy Bitcoin and I didn't buy NVIDIA. And that may not be the right decision. But back to Prof, your nice strategy when you talk about roll-up. So any one of you that has businesses that is suitable for rolling up, then you could probably make an offer to the private equity, a buyout fund, and say that, yep, my industry is very fragmented. Why don't you come and buy over and adopt Professor's strategy and get him as an advisor? But when you get him as an advisor, you can pay me. and then how do we roll up all these strategies to build a transformational change in the industry? Okay, Prof. Just now you talk about family business. And yes, I understand because I'm accountant by training, finance trained. None of my 3 boys is in finance because they look at how the father is, they say, I don't want to be like you. But I think the question here is that from a family business owner, there are, I think especially Asians now, we are going through a big transition of wealth. Those in the first generation are looking at a lot of wealth that has been created by them, and it will be transitioning to the next generation. And the estimated is that the next 10 to 15 years, there will be a great wealth transition.
In Asia more than the rest of the world?
I would say in the rest of the world too, but a lot more in Asia and Middle East, because the new wealth are actually created in Asia over the last probably 40, 50 years. Then the transition is going to happen. Any advice to some of our audience, as well as I think some of them may be coming from wealthy family? You may want the cash rather than the business. So Professor's answer will be critical and important to how to navigate that conversation.
Well, I mean, I think it depends. Obviously, managing wealth is different than managing a business, right? So private equity would help manage a family business. So, the case I don't know, I think by example. So I used to teach a case about a restaurant chain in the U.S. where it was owned by this brilliant guy who was in his 70s or 80s and was very particular about how he wanted it run. And he was able to, there was a buyout fund that was able to acquire his company and then improve the operations, and he was happy to let them do that. In terms of managing wealth, I mean, if June were here, she would say donate it to NTU. But yeah, I mean, I think that the transition is obviously very, very tricky sometimes, right? Because sometimes you have to. It's hard for the children to live up to the parents' expectations, but that's more of an issue for psychologists than a finance professor. But I think in terms of managing the businesses, it's sometimes tricky, right? Because you don't, if you start a career, many of you here want to be entrepreneurs and start your own companies, right? And if you're successful, in 30 years when you want to hand it over to your kids, they may not want to do it, right? They may want to be a doctor or an artist or whatever, right? And so in which case you have to manage the transition. And again, private equity can play a role in this, depending on whether you have somebody who you want to take over the business or not.
Yeah, thanks, Prof. Yeah, but just to share another story, my son is 23 years old. So he just finished his national service. I asked him whether you're going to continue your study. He was doing game development, game design. And then his answer to me is, not really. Then I say, son, you are unemployed. Then his new term to me is that, Dad, I'm having fun. In our generation, it's called fun employed. And if you have money, you can give me money, and I can play with shares. So that's calling fun employed and managing my money. But I don't think I trust him yet. But this is the new generation where really in terms of having successor taking over the business becomes a big challenge. Any advice to the patriarch, the matriarch, in terms of how should they approach the private equity?
How they should private equity. I thought you should approach parenting. You could say, you could ask my kids, and they would give you a different answer than I might. But I'm sorry, what's the question again?
Yeah, if I'm the business owner
Yeah.
and I don't have a successor,
Yeah.
what should I do with my business, especially it's a decent business and could be of interest to buyout funds?
I mean, one of the rules about, one of the things about this business is that most businesses are auctioned nowadays through an investment bank. Now, what private equity funds try and do is they try and get business to meet the people away from the investment banks and to source their deals through their networks. And the idea is that they like that because they can typically buy the assets cheaper. But if you have a firm that you think would be an attractive target for a private equity fund, I would recommend you get an advisor and try and get the highest price, which would involve having different funds compete for your business. And usually an investment banker is the best way to do that.
Yeah, I can volunteer the service too.
Yeah.
Sorry, just a sidetrack. Then there's a question here about a bit sensitive topic about this geopolitical tension. And because of geopolitical tensions, especially industry like semiconductor, how would that affect from a buyout perspective, especially if it's a cross-border related type of business?
Well, I think it will make it harder. I mean, one of the things that's happened that was, I thought, terrific was there's been lots of international investments, especially in China and India. Those were the two biggest targets for international funds, by U.S.-based funds, but also European-based funds. And, I don't think we really want to talk about geopolitical tensions in too much specificity, but I think it's fair to say that it's a lot harder to do investments in countries where there's tensions between the governments. And I certainly think that it's going to be hard. It's going to be harder for U.S. funds to invest in certain parts of the world. And I think that one of the things you might see is you might see more funds raised in the local countries where the assets are. Because, again, one of the things I was trying to say for the last hour or so is that, buyouts occur because they sort of satisfy a fundamental need for financing of certain kinds of projects that require financing through funds that cannot be financed without funds. And this is true in every country of the world, and it's true regardless of the political issues between different countries. And so that I think one thing you might see is you might see more funds being raised locally and investing in their own countries. Another thing that's happened is that sort of private equity, as we know it, was really created in the U.S., and so that for a long time, the U.S. was the biggest market, both in terms of capital and also in terms of expertise. And what you've seen is a lot of the funds that have been raised outside the U.S. have been people who've had some affiliation with a U.S.-based firm, and they kind of know all the tricks of the trade, and they maybe have an MBA from the U.S. And this was the way it was 20 years ago. And I think this has changed because now you can get an education in Singapore. There's lots of people who know how to do this in Singapore. You don't need the U.S. anymore. And so you can raise a fund in Singapore with local currency and do investments here and in this part of the world. And I think that is likely to be the future. But again, this is my pure speculation. But I think that private equity has become somewhat commoditized in that it used to be that, well, the Harvard Business School taught a course in private equity, and then Chicago taught one, and they were the only ones. And now every school in the U.S. and every school in the world teaches it, and the basics of a term sheet and how capital is raised. This is taught to every MBA student and hopefully most undergrads as well. And so the ability to raise capital and start a fund outside the U.S. is much easier to do that now than it was 25 years ago.
Yeah, thanks, Prof. Yeah, one question that pop up here, which looks quite interesting, is that the source of fund of private equity funds, basically talking about the LPs. Traditionally, they are the pensions funds, the big insurance companies where they have collected a lot of money. But in recent years, some of the fund size are smaller. The LPs could be from family office individuals. Any perspective or any views in terms of how some of these KYC, know your investors, being done, and would that affect where they can invest? And is it necessary for the LPs to be known to the companies that are going to sell to them, or sell to the private equity?
Okay, a couple of things. So one thing that you may have noticed is that the IPO market has been really slow lately. The deal market has been very slow lately. There's been a bunch of reasons for that. One of just the higher interest rates and the inflation and COVID and all this has really slowed up deal making. And so that, actually Soo Earn mentioned this before the talk, so to me, is that a lot of the LPs, therefore, have their money in private equity funds, and there has not been exits. And so therefore, what the typical model is, they take the money that is exited, that is returned to them, and then reinvested in the next private equity fund. But now the money is not being returned to them, and so they don't have any extra. So what the LP will typically do is they will allocate a certain portion of their portfolio to private capital and to public capital and to liquid. They call it, our guys at OSU call it liquids versus illiquids, but basically means private versus public markets. And so since the private funds have not been exiting, the LPs have not been getting this inflow of cash that they can reinvest in the new funds. So it actually has been kind of hard for the funds to raise, the fund families to raise new funds. And so one of the things that's happened is they have turned to alternative sources of finance for the funds, so that typically the traditional source of capital for funds has been, endowments and pension funds and large institutional investors, both in the U.S. and around the world. And so what they've done is they've tried to come up with other sources of capital, so that one of the sources has been these family offices. As was just mentioned, there's been a lot of wealth creation in the last 20 years, and so there's a lot of rich people who don't know what to do with their money, and so private equity is trying to get them to invest in there. Another thing that's happened recently is that some of the mega funds, so that when Blackstone and TPG and KKR are raising like $20 billion at a shot, what they've done is they've created vehicles whereby small investors can get into those funds. Because traditionally, if it's a $20 billion fund, then they don't want to take a capital commitment for like less than $50 or $100 million. And that's like too rich for most people's blood, right? So that what they've done is they've created vehicles whereby they will allocate a $100 million block and sell it in $50,000 chunks. And so $50,000 might be the kind of investment that a wealthy but not a super wealthy person would be able to make. And then, and so the vehicle that would have shareholders that are relatively small shareholders could then invest in the mega fund. And all of these are being done for the purpose of allowing the Blackstones to raise even bigger mega funds by allowing the small investors to get access to these funds. And so one of the, I keep emphasizing that the private capital market is incredibly interesting and is always changing, and it's because they're always innovating in so many different dimensions. And one of the dimensions in which they are innovating now is the way in which they are making their funds accessible to small investors, because typically they have not been accessible. And the reason why they're doing that, I think, is sort of the fact that their traditional investors have not been able to increase their allocations to the extent that fund managers would like them to.
Yeah, thanks, Prof. I don't want to dwell into the KYC thing, so let's move on, because this question is more about retail investors. Whether is there any perspective if I'm a retail investor, and how do I participate in the private capital market?
Well, you can. I mean, either you can contribute through one of these vehicles in the mega funds, or there are lots of smaller funds that, in your community, I assume in Singapore there's lots of capital, but even in a place like, Columbus, Ohio is the 15th biggest city in the U.S., so it's, 1 million people, but it's not Singapore. But we have a number of smaller funds based in Columbus that I mentioned, the hotel fund, there's funds that invest in apartments, we have a really good venture fund, and so some of them have been lowering their capital commitments to $100,000 or $200,000, which again, to the students in the back, that's a lot of money. To people who have been working in a high-paying job for a while, it's a good investment, but not an insanely large investment. One of the things you have to be aware of is that you effectively lose control of your money. So you can't take it out, and if you decide that you want to buy a house or that you want to buy an expensive car, or you change your mind and you want to do something else with the money, you're sort of stuck there, and you're very dependent on the funds and their drawdown schedules, which is not your decision, right? So that you might get an email saying that you owe $50,000 in the next 2 weeks, and so that if you're or you might not get that email, and you might have the $50,000 sitting in a bank account earning 2% interest or whatever, and so that it becomes a part of your portfolio that you have to manage. And I don't know if most retail investors are aware of the complications there.
Yeah. One follow-on question is because there are quite a number of private equity funds that are now listed. So whether on US or UK stock exchange.
It's a very interesting thing, because private equity funds for years and years and years that we are private, and we get so much value being private. And then they started doing IPOs, okay? And one of the reasons they are able to they did it is because they were enormously profitable for the founders. What they were able to do is they were able to monetize their stakes in the fund, and essentially get claims on all the future investments that the fund will ever do, even after they're dead. And so, so I teach a case in my class about Blackstone's IPO, and it turns out that Steve Schwartzman's amount they earned on just the IPO when Blackstone went public was about $7 billion. So that's not bad for a day's work. Because it's basically his share of the profits of Blackstone forever, right? So, that's why I think that's why they went public. And the fact is, though, they've been able to continue to. I'm not speaking into my micro. Yeah. So they've been able to continue to earn high returns, even being public, which some of us were a little skeptical that they would be able to do at the time.
So as a retail investor, should we buy into some of these shares?
What's that?
Into the private equity that are listed.
Oh, I'm just a professor. I can't afford that. You're at Deloitte. You guys. So.
I'm not a stock market analyst and all those. So. But let's open the questions Q&A to the floor and to the audience. We have about 10 minutes max. Any questions or any challenging questions that you would like to ask Professor? You can raise your hand, and the microphone will drop down from somewhere. Okay, the mic is going to you. It'll be good if you just have mentioned who you are and then the question, definitely directed to Prof.
Hi, I'm David from NTUC L Hub. not so much interest of the workers for the unions, but it's more from my personal interest because I've been with Hewlett-Packard, and there's a lot of all these buyouts and so on. So I'm actually curious whether there's a studies, how does it affect the employees?
There's been a number
in terms
of
of employee
studies
value
about-
propositions.
Yeah, there's been a number of studies like this, and I think that on average, the employment goes up a little bit following buyouts. Of course, that's on an on-average statement, so sometimes it goes way down and sometimes it goes way up. But I think that, again, the basic principle is that they will do what they can to increase returns. It's just that often what that means is by growing the company and increasing employment. Sometimes it means, cutting back and selling divisions and laying off workers. But I think that that's not the most common thing that happens. I think on average, the employment tends to go up. I mean, it all, I don't think there's any one rule. I think that a lot of managers prefer to work for private equity than for public companies. It's much more lucrative. And, a lot of workers prefer to do that as well. I mean, but some workers don't.
Sure.
Thank you.
Just sharing an experience. I work with one of the top 5 private equity firm doing a buyout and privatization of a Singapore-listed company many years ago. And one of the key challenges is always change management because ownership will change. The way that things are being carried out and all this could change. So one of the key process is that that has been put in place as soon as the deal has been approved is actually internal communication. How would that affect? What kind of scheme could be put in place for retention purposes? Especially listed company, a number of employees has share options or performance shares. And when it's privatized, how do you convert that? So private equity love these things on management equity participation scheme. So it can be put in place as well. So there are those elements that you try to make sure that you retain the key personnel. And that's critical for especially the way that how you want to carry the business forward and all the conditions that Prof talks about, the transformation. And if those are key people, then you want those people to be around. Okay, any other questions? See, Singapore is sitting here is always very good because nobody asks questions. Yes, very good.
Hi, Professor. I'm a postgraduate student from Applied Economics, and you just mentioned those 2 and 20 fees. I think 2% for management fee and 20% for bonus. My question is, do you think the traditional 2 and 20 fee structure needs to be adjusted to meet those modern investments demands for fairness and transparency? Thank you.
Okay, well, a couple of things. One is they're very transparent, right? I mean, 2 and 20 is 2 and 20. I can write on the blackboard. You can look at the form. It's well known to all the people involved in the transaction. It's not public information, but it's transparent to all the relevant participants. One of the things that always happens is GPs and LPs, they don't agree on everything. The LPs want lower fees, the GPs want higher fees. And, and they have something called the golden rule where he who provides the gold sets the rules. And so that the GPs are always trying to, keep their 2 and 20, and the LPs are saying, look, 2 and 20 was invented when funds were 60 million. Once upon a time, in my lifetime, the largest fund in the whole world was $60 million with an M, and now you saw trillions up there as the total capital, and the funds are, many billions of dollars, and so that the 2 was to manage originally intended to pay for the expenses of the fund. And now 2% of a $10 billion fund, and you can do the math. It pays for a really nice office, even in Singapore. So one of the concerns of the LPs is that they would rather have more of the compensation being carried interest in terms of these management fees, and they would like to have the management fees decline. And so I think that the typical fee structure, even though we always say it's 2 and 20, it really isn't 2 and 20. It's really a little bit less than that. But it varies across funds, right? So the best venture funds typically get 3 and 30. And for Sequoia Capital, I think it's, again, it's not public information, but I'm pretty sure it's 3 and 30, and they're so good they could get 5 and 50 and still raise funds. And at 3 and 30, many endowments who have not been traditional investors in those funds have not been able to get into the funds because they close. So that, again, I don't know if I answered your question or not, but certainly the fee structure, it is fairly transparent. And there's always a lot of, tension over the fees, right? Because it's a lot of money and it affects returns, right?
Thank you, Professor.
You want to add something to that?
No, because I don't earn any of the fees. But whatever Prof says is right. There's a lot of negotiations. There's a lot also dependent on the reputation of the team as well as the reputation of the GPs. Of course, newer GPs that come into the market, some of them actually doesn't even ask for a management fee. It's all driven by success. So there are all sorts of different models that's available in the market depending on who are the people driving the GPs. I can have one last question before I got kicked out from here. Okay. Make sure it's a super hard question for Prof, so he can remember you.
I'll try. My name is Soo Earn. I'm from ESR Group. Just a question about the current hot topic about ESG and the environmental aspect of investment. So, Professor, what is your view about private funds and the influence of the environmental consciousness and the activism of the investors? Do you find, like from the graph that you provide, the infrastructure, the REITs, does it figure and will it more or less like increase the value of the ESG in people investing in private funds? What are your views, sir?
Well, I mean, certainly a lot of investors, and I think this is especially true in Europe, they really care about ESG. And they don't want to invest in oil companies, and they don't want to invest in coal companies, and they only want to invest in environmentally conscious companies. Now, I have my own views about ESG because the E and S and G, it's not clear to me why they belong together. And not clear that when they invest, they say they invest in ESG, they care about the G part very much. It's mostly the E. But all that being said is the investors care about it, and so therefore the GPs care about it. And they do. And so, I've had GPs who've told me that, I wanted to buy this asphalt company because it would have been really profitable, but my LPs would have gone ballistic, and so I didn't do it. And so it really does affect what they do, but only because the LPs care about it, right? So again, the GP, his goal is to keep the LPs happy. And because if you're a GP, if you can keep your LPs happy and they're investing in your next fund and your next fund, then you do very well, right? And so, yeah, so I mean, that's why I think that you're nodding your head. Is that the right way to think about it? Yeah.
Yeah. Definitely, because even for us, we see that the LPs are demanding the GPs to have a policy, ESG policy, and when they are doing investing, they call it ESG diligence. What are the areas that needs to be covered before you get all the ticks, then you are able to invest. So that's what LPs are expecting. I was thinking that he's going to ask about their own current situation about privatization. It's in the news, so it's not any market secret. Okay, so thank you very much, and thanks, Prof, for the enlightening discussions. Don't buy any shares, don't buy any stocks, because this is not for advice on which shares and which stocks to buy. Because Prof has already told me that's not an area that we can get into. But hope you enjoyed the conversation, the discussions, and One best way to do is you can Google and find Prof's email. And my discussion with him, hopefully it stays, is that any email you send to him, he can help to reply. And if he can reply you, your questions in 5 minutes is free. But whether it takes 5 minutes or longer is up to him. So you better watch what you ask. So with that, thank you very much. Thank you, everybody.
Thank you all for your thoughtful questions, and a special thank you to Mr. Soo Earn and Prof. Michael for the engaging discussion. Now, we would like to take a moment to express our appreciation to both our speaker and moderator. Could you both please remain on stage? Now, may I invite Dean Yang back onto stage to present the tokens of appreciation. Dean Yang will first present the memento to Prof. Michael. And now the memento to Mr. Soo Earn. May I kindly request Prof. Michael, Mr. Soo Earn, and Dean Yang to remain on stage for a group photo.
Let me speak 2 words. There are 2 things. One is the ESG related issue. The new series is Sustainable Business. We'll talk a lot more about that. So the first talk is on January 9th, is taking the risk perspective to look at the discussions on the ESG, especially environmental related issue. So the second thing is there are a lot of research on that, and now people are talking about greenwashing to a large extent. So in Europe, the talk really has to walk. You walk the talk, mostly for European funds. That's less so in the US. So in Asia, there are several countries that are leading the trend. That's Japan, Korea, and Singapore. Actually, we just launched a new academy called Carbon Academy. That's our schools. It's Carbon Academy. We want to contribute more to ESG-related discussions. We want to do more for Singapore and the region. So that's a great question. That's a natural connection to our next series of lectures. Thank you.
Thank you, Dean Yang. Now, could the 3 of you take a group photo together, please? Thank you. Before we end, just a friendly reminder on the 18th February event. Do scan this QR code if you are interested. And with that, we conclude tonight's event. A big thank you to Prof. Michael, Mr. Soo Earn, and Dean Yang, as well as everyone who has made the event possible. To all our attendees, both here and online, we hope you found the discussion insightful. Just a little note, as you guys are leaving, do kindly leave your lanyards on the table outside the auditorium. Thank you once again for joining us tonight, and have a lovely evening ahead. Until next time, thank you.